Hello guys, Nirav here coming to you with a quick update on Nifty 50. So right now here on screen we are discussing the same triangle which we were discussing on the day I did the webinar, which was on 19th September. So before moving further, let me just clarify what the thing is going on over here. So currently we have, let me just remove some stuffs for more clarity. So we have currently on screen what we think is a possible triangle structure, with the starting point of the triangle is this point of reference with the high of 17992.20 on 19th August 2022. From this point on, we are seeing a triangle, and let me draw the rough outlook so that you can better visualize it. So a triangle will have the first leg down, which is called the A wave. The second leg up is called the B wave, and then the C down, the D up, and then the E wave down. So in this particular structure, this will be our A wave complete, B wave complete, C wave complete, and now D is the one which becomes the point of interest for us, or the one which will trigger trades for us. So when we look at the D wave, first of all, let me just quickly show you the chart which we discussed on 19th September in the webinar. So at that point in time, the view was that it will move up for the wave D. So basically price was around 17,650, and this was the resistance zone, this white box, where we were expecting the price will go at least and then either consolidate there or maybe go a little bit higher. So from 17,650 we were expecting upside, as was discussed in the public webinar. You can check the recording on YouTube. Now from 17,650, which was somewhere here, somewhere here, we did see a move to the white box, and the market actually reversed from within this resistance zone, right? So that analysis played out picture perfect. Now the point of understanding our discussion becomes about this wave D. Now as we know, in a triangle, wave D can go as high as the wave B end, right? So basically it is possible that this market goes higher, and that will be the D, and then it will go down and then new leg up, right? So that is definitely possible. So that's why it becomes important we check a few more things here. So for that, let me just bring the counts up on screen again. Now the first thing is, when the market was progressing after the end of wave C, we seem to be having a parallel channel already drawn, and this is drawn from 0 to B. Let me check. Yeah, so we have an A up, B down, and then C up. So we will draw the channel from the starting point of wave A and to the ending point of wave B. We will draw a line, and then we will draw a parallel line over here from the ending point of wave A. So now this line gives us rough upside targets for the wave C, and it did seem to have done a pretty good job at it. Now that's done and over, we see that the market has sort of gone on, and it has very nicely filled this gap which was left. As you can see, it precisely touched the low. Let me remove everything. Now again you can see now it precisely touched the low where the market gapped up last time, right? So it has done a fairly good job at it. Now what does that mean with our, or in accordance with our Elliott wave counts? So in accordance with our Elliott wave counts, as I said, this D may either be complete here, this E may be complete, or it may be going down a little bit, or E's can also form triangles within themselves. But leaving that aside, that's not really important at this point. So the thing is, it could go up for the new impulse up, or it could just be going up for this D, which is continuing possibly as a complex structure, WXY to be more precise. So it would look something like this: W and X maybe here, and then Y in three waves. Yeah, you can also call it a double zigzag if you want to be very precise with the naming. But if we think about it, if we take this WXY structure, then we expect the market will go higher. Let's call it the hypo 2. And if we consider that the D wave is already complete, then we expect the market to yet again go higher. Let's call that as our hypo 1. So in both cases, the market is going higher, and technically our stop loss should be below the wave C low. So basically that means with the stop loss below the wave C low, which is coming at the level of 17429.7, we can take swing long positions, right? So basically if our count is correct, right, and this is actually a triangle structure with the wave C correctly counted, which so far looks to be the case, then swing longs with the stop loss below wave C low can be taken, because both the possibilities which we expect the market to take are taking it in the upside direction. So that's our quick update on Nifty. Thank you.